Now the accepted theory is, oh yeah, there were researchers in China working on what was called gain-of-function research. All right, so I'm by no means a microbiologist, so I can't speak very knowledgeably about what exactly does that term mean in that context in terms of coronavirus. But clearly what Bessent is doing is grabbing that term and applying it here, and his point is there's mission creep, right? The Fed has, especially since the 2008 crisis, has moved beyond what its traditional toolkit was and even what its ostensible purpose was. In other words, it's expanded both its means and its ends since the 2008 crisis. And so that's what he's cleverly labeling as the Fed's gain-of-function policy, meaning the Fed is now adding more functions to its toolkit.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I am going solo, and I am going to go through a recent article that Treasury Secretary Scott Bessent published in the International Economy. That's like some journal, the spring 2025 edition. And it was surprisingly good. And I'm not saying that like as a backhanded compliment to the Treasury Secretary. It's just, this is good enough that if I had come across this essay and just thought it was some academic who wrote this up, I would consider just interviewing the person and having him or her come on just because I like the topic. And the person raised several good arguments. A lot of them, things that, I've independently thought of, but there were some things in here that I actually hadn't known about. And so anyway, I'm just saying it was surprisingly good. And also, I partly decided, this should be a good topic for me to cover because I beat up on the Trump administration so hard with the intel stuff that I want to show I'm tough but fair. Right? I don't want it to come off that I'm just always anti whatever the administration is doing that week. And so here I did want to cover this. Also because, but let me put it this way, Donald Trump is in the midst of a power struggle with the Federal Reserve. He's had a long-running feud with Jay Powell. And then now more recently, he's come under fire for attempting to, and as of this recording, some court somewhere said you couldn't do it thus far. He tried to fire Lisa Cook, sitting on the Fed Board of Governors, over allegations that she knowingly wrote false things on her mortgage applications. So that's all going on. And so this is the context of the Trump administration criticizing the Federal Reserve. And so this essay coming out where the Treasury Secretary is explaining his problems with the Fed and how it's been run, one might have thought like, oh, this is just going to be some hatchet job and real shoddy work and whatever. And true economists looking at this, and it's not that. One could say, oh, Bessent knew what he wanted the answer to be and backfilled the arguments, but okay, the arguments were really good. I'll put it that way. Okay, so with that preface, let me just go ahead and just start commenting on this stuff. Of course, we'll link to it at the show notes page. I encourage you to go read the whole thing yourself. It's not that long. It is, I think, 16 pages. Oh, no, only 9 pages. Sorry, it starts on page 16. I'm looking at this Adobe reader. I think it's only 9 pages long. Okay. So right out of the gate, what's interesting about this is the title that he says, the Fed's new, quote, gain-of-function monetary policy. And the subtitle is overuse of non-standard policies, mission creep, and institutional bloat are threatening the central bank's monetary independence. All right. And then just the opening sentences here will show what do they mean by that title. He says, as we saw during the COVID pandemic, when lab-created experiments escape their confines, they can wreak havoc in the real world. Once released, they cannot easily be put back into the containment zone. The extraordinary, and that word is in quotation marks, monetary policy tools unleashed after the 2008 financial crisis has similarly transformed the U.S. Federal Reserve's policy regime with unpredictable consequences. The operating model is effectively a gain-of-function monetary policy experiment. The Fed's adoption of large-scale asset purchases as a tool of monetary policy, when its traditional instrument, the overnight interest rate, was at the zero lower barrier, created severe distortions in the market with unintended consequences, and it has disturbed the Fed's unique independent role in the U.S. political system. Central bank independence is fundamental to the economic success of the United States. Okay? So that's the opening paragraph. I thought I was just going to read some snippets of it, but I realized the whole thing was good and you kind of needed to hear the whole thing to understand the train of argument. Okay, so that's where they're coming from. So I just want to know rhetorically what he's trying to do there. he's trying to flip the criticism on its head, right? So rhetorically, this is quite effective. And then we're just going to see if he pulls off the landing, sticks the landing, that the critics of the Trump administration are saying, whoa, you can't have the president publicly browbeating the Fed chair saying he's being too tight. Why isn't he cutting rates? He's killing the economy. This is crazy. I can't believe this guy is in there. Am I allowed to get rid of him? I might ask him to get him. My lawyers are looking into it to see if I'm allowed to let him go and and then trying to fire Lisa Cook, presumably to put somebody else on the board who's more amenable to Trump's views on monetary policy and so forth. So in that context, the number one thing that the establishment critics of Trump, who, it should be said, don't like Trump for 19 other reasons too, right? There weren't a lot of people who were really on board with Trump except for this one thing. But anyway, the number one thing they do, and this includes people like Janet Yellen and other tenured Ivy League economists, coming out and they say, oh, Donald Trump with his ego and disregard for norms of public policy is threatening the independence of the Fed. And since the 1951 accord between the Treasury and the Fed, it has been understood that monetary policy is distinct from fiscal policy. And the Fed does not exist to serve the interests of the White House. The Fed exists to make disinterested judgments based on scientific data and peer-reviewed models and blah, 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 right? That's the idea. And so they're saying Trump just out of nowhere in this unprecedented fashion is interfering with the Fed. Okay, so I'm not going to get into it here. I'll link on another podcast. I've gone through that and explained, yes, I don't agree with what Trump is doing. Like, for one thing, I don't want the Fed to create more money and inject it in the credit markets. I think that would just spawn another business cycle. In my view, as an Austrian economist, that's what I think causes business cycles, right? So I think if Trump got what he wanted, it would just set the economy, U.S. economy up for another boom bust cycle. So I agree with that. But this notion that, oh, up until Trump, U.S. federal administrations haven't been pressuring the Fed to do things that were in the short-term political interest of the party in power, like, that's crazy. All right. So anyway, if you want to see more on that, I will link to, I have an article that's forthcoming going through this stuff. And I also, like I say, have another podcast that I did on that. But that's not what concerns us here. Here, I want to focus on the Treasury Secretary's article. So I'm saying, given that that's how the critics are smacking Trump, Bessent here is trying to flip it on its head by saying, oh, no, the Fed needs to be reformed because right now it's not adhering to its vision and goal of being an independent central bank. Okay, so that's partly what he's doing here. So as we're going to see as we go through this, and also the gain of function stuff, I'm sure most listeners got that, but the stuff that was going on in that Wuhan lab, that the leak, which is now the accepted theory, even though there was a long stretch where that was so taboo, like you could get in trouble if you said that. But now the accepted theory is, oh yeah, there were researchers in China working on what was called gain of function research. All right, so I'm by no means a microbiologist, so I can't speak very knowledgeably about what exactly does that term mean in that context in terms of coronavirus. But clearly what Bessent is doing is grabbing that term and applying it here. And his point is there's mission creep. The Fed has, especially since the 2008 crisis, has moved beyond what its traditional toolkit was and even what its ostensible purpose was. In other words, it's expanded both its means and its ends since the 2008 crisis. And so that's what he's cleverly labeling as the Fed's gain of function policy, meaning the Fed is now adding more functions to its toolkit. Okay. Let me, because I'm looking ahead here and Bessent starts getting into some specifics. Let me just take a quick side quest here and explain that partly why I was so intrigued by this approach that the Treasury Secretary was taking is because it dovetails with something that I've written regarding the Fed. So specifically, I had an essay, it's in a collection somewhere. I'll see if I can find it. But I don't think the PDF is available. I think you'd have to buy the book. Where I titled it, Ben Bernanke is the FDR of central bankers. Okay, so what I meant by that title was that say what you will about FDR, both his friends and foes agree, he fundamentally changed what Americans perceived as the proper role of the federal government when it comes to the economy. He did all kinds of other stuff too, but that's clear. Incidentally, as I've done in some of my work drawing on the work of others, don't think from me saying that meant Herbert Hoover was a do-nothing laissez-faire guy and just sat back while the economy imploded, and then FDR finally was willing to roll up his sleeves and have the federal government. That's not what happened. All right. Herbert Hoover was the most interventionist U.S. president in peacetime up to that date. Okay. And then it was just FDR took everything Hoover did and multiplied it. Okay. But you get the point that clearly the New Deal and all the other things that FDR brought in during his terms changed the footprint of the federal government in the U.S. economy in a permanent way. And it just made Americans come to believe that, oh yeah, that's XYZ, that's part of what the federal government's job is to do when it comes to the economy. Whereas Americans in 1906 probably would not have thought that, oh yeah, it's the federal government's job to take care of you when you get old. That, no, that's what your savings and your family and the church is supposed to do. Washington, D.C. is going to take care of everybody once they retire? What? That's crazy. Why would they do that? Anyway, the central bank, the Federal Reserve, after the 2008 crisis, had a similar transformation where the Fed did all these extraordinary, and that was the terminology that they themselves would use, programs and procedures that allowed it to do things that it hadn't done previously, but also qualitatively what it was doing was a more significant intervention in the financial markets than before. So loosely speaking, prior to that, the Fed basically set interest rates, and the particular way that it engineered that outcome would be through buying and selling treasuries. Right? That was basically how the Fed operated. If it wanted to lower interest rates, it would buy more treasuries that would create more what's called base money in the system. And then banks, because they kept their reserves parked at the Fed, were earned 0% interest, they typically would, I'm speaking loosely, lend it out or make more loans to their customers, pyramided on top of those reserves, which is a more accurate way of saying it in terms of the accounting. And so that's the way. And since the short term, what's called the the federal funds rate is the overnight interest rate on reserves that banks charge each other, reserves parked at the Fed, that's why increasing the amount of reserves by buying more assets is the way that the Fed either, put its foot on the gas or put its foot on the brake, if you want to use that metaphor. All right, so that's what the Fed did going into the fall of 2008. And then after, as we know, it had all of these other programs, like short-term facilities and things like that, where banks could pledge mortgage-backed securities as collateral and get these huge, billions plus of short-term loans and things like that. The Fed eventually began its programs of what outsiders dubbed quantitative easing. The Fed never actually called them that, where it bought not just treasuries, but also hundreds of billions of dollars of mortgage-backed securities. Okay, so that was a completely new thing. If in the year 2005, the Federal Reserve said, hey, we're thinking about buying $85 billion of mortgage-backed securities a month, people would have been shocked, not just at the number and the scale of the purchases, but also at the thing being purchased. They see, you can't buy mortgage-backed securities. Wait, you know how that's distortionary that would be? Why would you put your thumb on the scale in that particular way? Why would you give so much stimulus and credit inflation to one particular sector like that? That's crazy. Just like in general, if the Fed had the ability to go buy stocks or even broad-based things like options on the S&P 500 or something, that would be alarming. Like that would be opening the door to corruption. Okay. Besides just being bad, quote, economically. All right. So I'm just saying that that's what I meant. That's why I titled my essay, Ben Bernanke is the FDR of central bankers, because he was out there on 60 Minutes and whatever selling all this to everybody. One other interesting thing I dug up in that essay is it wasn't just that I disagreed with what the Fed was doing as an economist, but also my understanding is that they were on dubious grounds legally. So there's another parallel that I drew to FDR, where it wasn't just as an economist, I was against a bunch of stuff they were doing, but it was clear-cut violations of the Constitution. And that's why FDR had the starting to pack the Supreme Court and everything, and they had standoffs over, and they, some of the original New Deal was thrown out, and then they had other stuff go through after the court packing threat and so on, is because by a plain reading, clearly a lot of the stuff that happened under the New Deal was obviously unconstitutional. Okay. So likewise here, just to give one example, was the Federal Reserve, according, to the statutory authority and everything, was not supposed to be directly buying financial assets, mortgage-backed securities and stuff like that. And so the way they but it was allowed to lend to financial institutions. And so the way they got around that is it was something like they set up these LLCs called Maiden Lane. It was like Maiden Lane 1 and Maiden Lane 2. And they were just LLCs. Maiden Lane is a street in New York City near Wall Street. So that's where that term came from. And so it was like, oh, the Fed, even though you could go like to the Fed's website and stuff and look and see how much in terms of mortgage-backed securities is on the Fed's balance sheet right now, strictly speaking, my understanding is it was these LLCs, these Maiden Lane LLCs were the ones that directly bought the mortgage-backed securities with money that the Fed lent to them. And so the Fed was telling the lawyers, we're not violating any statutes here. We're not buying mortgage-backed securities. We're lending to Maiden Lane 1 and we're lending to Maiden Lane 2. We're allowed to lend to institutions. Yeah, I mean, maybe they're going and buying mortgage-backed securities with it, but we're not. Okay, so that was some of the chicanery involved. And I cited somebody had an article in a law review journal going over that stuff, just talking about the legality, the dubious legality of what Bernanke's Fed was doing. Okay, so all that's to say, we come back from the cul-de-sac now, side quest has been accomplished, that Scott Bessent going down this path, I understand where he's going and I'm all ears. Okay, and incidentally, a lot of what he's going to say in this, I actually think is conceding too much, right? So this is actually a fairly conservative, in that sense, critique of the Fed. For example, he says, in the aftermath of the 2008 financial crisis, the Fed was understandably determined to help revitalize the American economy. It had just successfully modernized its traditional responsibility as a lender of last resort, helping to stabilize the financial system. This role, as described by Walter Bagehot in Lombard Street of 1873, is a time-tested function for central banks in managing liquidity crises. Okay. By the way, that his name is pronounced Walter Bagehot, but you might be thinking it's Walter Bagehot or something because it's spelled Bagehot. I'm just saying that because I went for years thinking those are two separate guys, but no, it's the same guy. Just that's how you pronounce his name. So anyway, his Lombard Street, which again was published in 1873, is the definitive, he was writing it in the context of the Bank of England, but is the definitive guide for like classical, old school, this is what a central bank is supposed to do. So what's interesting here is the Treasury Secretary is crediting the Fed and saying, oh yeah, what you did when the fires were raging in the fall of 2008, when the world was falling apart, was great. You stabilized the markets. Good job. But I just have a problem with then you didn't stop there, then you just kept running with it, right? That's kind of I'm just summarizing, that's kind of where this whole piece is going. And I want to say, I think that's too generous to the Fed. That I've made this point before, but it's worth repeating. When I was in my zero hedge debate, when I was criticizing the Federal Reserve and calling for its abolition, that's being pretty critical, that was one of the points I made, that the Fed was failing, not just according to my value system and my metrics, but even the Fed's own ostensible purposes. And so one of them was, it's supposed to act as a lender of last resort. And so I pointed out that if you go and look at Bagehot's writings more specific or in more detail, you'll see that his actual recommendation was that in a time of crisis, the central bank should lend freely, but at a high rate of discount. I think elsewhere he says, or at a penalty rate. So the economic rationale there was, in a crisis, there's a rush to liquidity. And so what can happen is there can be viable business enterprises that are, they're profitable, successful going enterprises. They're not bankrupt. They're solvent. The present market value of their assets is higher than the present market value of their liabilities. There's positive shareholder equity. So they should stay in business in that sense. But the issue is they have a cash crunch, that they owe people money right now, whereas their assets are just claims on future cash flows, right? So they can't pay their creditors right now. There's a maturity mismatch in their assets and liabilities. And so what Badgett was saying is the central bank as a lender of last resort should come in, because you might say, well, if all that's true, everything I just said, why can't they just borrow the money, right? Why can't they pledge those good assets as collateral and have someone lend them the money, and then they pay off the immediate liabilities, and then when the assets do mature and they get the cash flows from those assets, they pay back the lenders and everything's great, right? As long as they're solvent. And the issue as well, because in a financial crisis, nobody's going to lend to you. That's kind of one of the hallmarks of a financial crisis and a rush to liquidity. And so there's plenty of businesses that would be fine in normal times when credit is flowing, but the argument goes in a crisis, everything seizes up, and then there's like this chain reaction where, yes, the dubious firms and institutions that might be like the cause of the crisis because they made a bunch of dumb decisions are stuck, right? They're genuinely bankrupt, insolvent. But then that causes this cascade effect in our modern financial system with everything intertwined and people leveraged, and again, having maturity mismatches. People are borrowing short and lending long and da-da-da-da-da. And so Badgett, he was arguing in a situation like that, it is appropriate. One of the reasons we have a central bank is to come in and be the lender of last resort, right? Meaning when all other lenders have failed, then the central bank comes in. But again, it wasn't, oh, go ahead and inject liquidity at 0%. No, he said you lend at a penalty rate. And the function of that penalty rate was to separate the wheat from the chaff. That if there is some firm that really should just go under, then that's why you charge the penalty rates, because those people are going to realize, let's just throw in the towel. That, it was like the easy money of the boom period that spawned their existence. And so that's why when the crisis occurs, you want those firms going under, because they really shouldn't have been sucking resources into them anyway. They need to stop and release those resources elsewhere to more productive, viable enterprises. That's the idea. Whereas the firm it's a good, viable enterprise, its assets are higher than its liability, it's got a short-term cash crunch, they're willing to suck it up and pay the penalty rate to the central bank because they know we just got to get through this crisis. Then once things calm down, we'll pay off our loan to the central bank that's rolling over at this painful interest rate, and we'll get our financing from elsewhere once things settle down. That's the idea. And so you want Badgett thought you want the central bank keeping those firms afloat, but not the other ones, not the deadwood. Okay? So take it or leave it. That's what he said. And I want to argue that's not at all what the central banks, including the Fed, did in the 2008 financial crisis. What they did is they slashed short-term interest rates down to zero. And they were just giving out boatloads of money to anybody posting collateral that the week earlier had been referred to as toxic assets. And then the Fed was coming in and saying, oh, no, they're not toxic if we buy them at par or if we lend against them at par. Okay. And so that's not what acting as the lender of last resort in the tradition of Lombard Street means. Right there, they were bailing out people. Okay. So I'm saying I think the Treasury Secretary is conceding way too much. Okay. And then he just goes on. Against this backdrop, the Fed extended its liquidity tools into uncharted territory, repurposing asset purchase programs as instruments of stimulative monetary policy. Okay. So the pivot that Bessent's making here, or the distinction he's making, is he's saying, I'm all right with the Fed and under Bernanke's watch coming in to rescue the financial markets when they were about to crash and to stave off the Great Depression 2.0. I don't think he actually says that in here, but this is just kind of the spirit of the article. But then, once they staved off the immediate danger of the whole system imploding, then going forward over the next several years during the Obama administration, for the Fed to be doing all these rounds of QE to try to goose real GDP growth, that is inappropriate, he's saying, to have all these extraordinary measures, because the Fed was still engaged in massive asset purchases years after the financial crisis hit. And so that's what Bessent is saying. That's what's inappropriate, and that doesn't work. So let me just scroll through this here and mention some of his things. I like this too. Here he's going to take on 3 of the alleged justifications for this new Fed approach. And as we'll see, just even on their own terms, they're all kind of eyebrow raising, right? So one thing was, so here Bessent, I'm quoting Bessent, but he's here summarizing, this is what they told us at the time as to why the Fed was doing this stuff. He says, lower long-term interest rates in theory would encourage borrowing for business investment and other productive activities that would raise real economic output. All right. So And so my response to that is to say interest rates serve a purpose. They're market prices. You wouldn't want central planners in Washington, D.C., even if they're 12 PhD economists, you wouldn't want them to try to lower crude oil prices in order to stimulate growth. You say, no, the price of crude oil should be based on genuine supply and demand. Yes, it would probably stimulate growth, certainly around the globe as a whole. The U.S. now at this point is independent, as they say, when it comes to oil, so it's not as clear cut. But certainly planet Earth as a whole, if they found a bunch more oil such that the price of a barrel of crude fell to $20, that would be good for real GDP growth. But that doesn't mean, if central banks around the world could all work together to make crude prices fall to $20 somehow, that would be good. Well, no, because the price has to be accurately reflecting what's going on. It's like the patient's got a fever, he's delirious, and someone takes an ice cube and puts it on the thermometer to bring it down to 98.6. Zaha, patient's better now. Like, that's, the point of the thermometer, it has to be the accurate reading. Otherwise, it's useless. So likewise with prices, that yes, lower interest rates go hand in hand with long-term business investment. But if there's not genuine saving backing that up, then you're not doing the economy any favors by lowering interest rates just by printing up money electronically. Okay, so that's kind of the Austrian critique of that element. So Bessent goes on. Higher asset prices driven by lower interest rates were expected to generate a, quote, wealth effect as newly flush consumers spent more, boosting economic growth. Okay, so again, in Bessent here, he's not attacking a straw man. These 3 points he's going through. So we just did the second one. Were all things that the Federal Reserve said during the rounds of QE to explain what they were doing and what the benefits were supposed to be from this. So that one, it's called this wealth effect. And the idea was, as the Fed buys long-term treasuries and all these mortgage-backed securities, it's going to, among other things, and push down even long-term interest rates as opposed to just short rates, which has already been pushed down to 0%. And that will push up asset prices in general. And so now consumers looking at their stock portfolios or maybe house prices, where they're just going to feel wealthier. And so other things equal, they're going to be willing to spend more rather than saving more out of their current income. And that was supposed to be a good thing. And so I want to say, as an Austrian economist, no, why would you think that? You're trying to make it so people save less and consume more. That's not the way to fix the economy, particularly because as an Austrian, we thought what happened. If you asked me as of 2008, 2009, what the heck just happened to the U.S. economy, I would have told you, and I was going around giving PowerPoint presentations to various groups of financial advisors and so forth, that, under Greenspan, the Fed had an easy money policy after the dot-com crash that helped, in conjunction with other federal programs and Fannie and Freddie and all that stuff, it helped blow up a housing bubble. People didn't save as much, right? Because their home prices were rising at double-digit rates. So you could see the U.S. savings rate plummeted during the housing bubble years too. And then there was a big crash once reality reasserted itself. Well, the Fed started raising rates, and then everything, that's when home prices peaked, started coming down. And then once that happened, all the people who were in housing for speculative reasons started trying to run for the exits, and then everything just collapsed. Okay? So if that's what you think happened, or if you think that's part of the story, then to be saying, so the way we're going to jumpstart the economy now that we're in the doldrums of 2009, early 2000, let's have the Fed just buy a bunch of mortgage-backed securities and treasuries to get consumers to feel wealthier again so they go spend more and save less. Like that, no, you're just sowing the seeds to just do what just happened. Okay. And then lastly, additionally, reducing the supply of government securities in the market was intended to push investors toward riskier investments, thereby stimulating greater economic activity through what is known as the portfolio balance channel. Okay, so again, Bessent's not attacking a straw man here. That was another separate argument made in favor of QE, was they're saying, look, at right now, there's been this rush to safety. Everybody wants liquidity. And so that's why, especially short-term treasuries, the yields on them were basically zero. Right? The people were just putting their money into treasuries, short-term ones, because they just wanted to know that their money was going to be there in 3 months, 6 months, and a year. They didn't need to earn a yield. And so Bessent is saying, because everybody was doing that and rushing to safety, they wanted to take away the supply of those things to then get people elsewhere. Okay, so that they would go and move out on the riskiness in terms of like the risk return trade-off. Okay, so that's on its own terms. Again, let me just say that. All right, I don't want to dwell too much on this point, but additionally, reducing the supply of government securities in the market was intended to push investors toward riskier investments. So when you're in the wake of, wow, everybody made a bunch of foolish investments, and the hedge fund managers and all these big investment banks or whatever, they were mispricing risk and they were investing in things that turned out to be a lot riskier than they realized. Let's not do that again. And then in terms of Fed policy, the third justification is, what we're trying to do is to get people into riskier investments. Okay, so you just see I understand where they were coming from, because the idea was, you don't want people just invested in treasuries. You want them out there in the real world. Right. But partly, just notice what's going on there. They're saying, the problem is the market's flooded with all this government debt. So we got to sop some of that up so that people can't just have their portfolios consist entirely of government securities. They got to go invest in other stuff, right? That's kind of the idea. But as an Austrian, I'd say there's another way to reduce the outstanding stockpile of government debt. I don't know, the Obama administration didn't need to run trillion-dollar deficits 4 years in a row. That also would have been a way to not have the market flooded with treasuries, okay? Rather than having the feds dump all these treasuries in the market and then have the Federal Reserve create a bunch of new money to take it out of the market and put it on the Fed's balance sheet, right? That also would have achieved that result. If it was like, we don't want people in the private sector having their portfolios jammed with so much treasury debt, okay, then don't have the treasury issue so much debt. That also would have achieved that goal. Okay, so then he just goes through and summarizes the fact that there's a lot of academic research showing that the Fed's policies did not boost real GDP growth, and certainly not the way that the Fed's own forecasts said they would. All right, you can take that or leave it, but is that just Bessent claiming stuff? He's referring to peer-reviewed academic literature. He also makes a point about wealth inequality. So here's a good excerpt. There's like a bunch of sidebars in this article. He says, financial markets are the other major cheerleader for unconventional monetary policies. This is not surprising given that the Fed's monetary innovations are intended to work by boosting asset markets. As the Fed pushes down interest rates, prices of fixed income instruments mechanically increase, and other assets are bid up by the Fed's deliberate desire to push investors further out on the risk curve. Despite scant evidence that this policy resulted in increased real economic output, it clearly created a significant support base for unconventional monetary policy in the financial markets, which are highly attuned to the presence of the Fed put due to the Fed's repeated financial rescues. Okay? And he just goes on to say how this, increased exacerbated income inequality and so forth, stuff that you can say, he's just talking about that in other contexts. Scott Bessent wouldn't care about income inequality. Okay, maybe he would, maybe he wouldn't. I'm not that familiar with his background. But what he's saying here is definitely true. That among other problems with what the Fed did post-2008, when more generally like its existence, certainly post-1971, is you can see standard metrics of income and wealth inequality all turn around in the early 1970s. And so a lot of left-wingers, progressives, and harder core like socialists and stuff will point to those figures. Look at inequality was getting better in the U.S. after the New Deal, the post-war era, and then it just turned around and started increasing again. And they try to make it look like it's because of Ronald Reagan. But no, their own charts show there's a turnaround in the early 70s. Like usually it's around like 70, the recession of 73 is when it hits. And so we'll say, no, it's not Ronald Reagan's tax cuts in the early 80s that caused this turnaround in the early 70s. Really, was there something major that happened in the U.S. financial system that might explain why all these inequality trends turned around? Oh yeah, Richard Nixon took the dollar off gold in 1971. That could possibly explain, right? So my point is, when the Fed's hands were untied and they could print boatloads of money in the 70s, which spawned the worst peacetime consumer price inflation in U.S. history, that's also when you see all these inequalities measures blown up. And that makes sense, right? If boatloads of new money are getting pumped into the system, it's benefiting some people sooner than others. And it's not the blue collar worker who has a fixed wage that the union renegotiates every year or something. No, as prices start rising, his paycheck stays the same. And it's only down the road he might get like a cost of living increase to recalibrate and try to catch up with, but he's been falling behind that whole time. Whereas like the fancy financiers, the speculators and people like that trading in the currency markets and derivatives and such, they're the ones that can be Fed watchers and see stuff and make trades to get ahead of the Fed's moves and so on. I'm not even talking like in terms of corruption, like that they have inside. I just mean in general, they're more nimble rather than people who earn a paycheck. Okay, so it's not surprising that these various measures show, even though total output went up by such and such, the return to, in terms of wages and salaries doesn't seem like it, they didn't capture much of the gains at all since 1970, blah, blah, that kind of stuff. That's what you would expect to see given the story about how the Fed comes in and distorts things that I just told. And so I'm saying Bessent gives a version of that here. What he means, by the way, with this Fed put, that was originally called a Greenspan put. So a put option says, you have an asset, and a put gives you the right but not the obligation to sell it at a certain price. So it's downside protection. All right. So if you have a share of stock right now, say it's 100, trading $100 a share, and you buy a put at 85, you've put a floor under how low it can fall because that gives you the right to sell it at 85. Right. So if it drops down to 70, you can sell it at 85. So you're like capping. You got to pay for it, obviously, but you're capping your downside. So what they meant by the Greenspan put was that Greenspan showed famously in the 87 crisis, a stock market crash, but just going forward, that anytime it looked like the stock market was in big trouble, don't worry, Greenspan's going to open up the monetary spigots and then the market recovers. And so that happened again during the rounds of QE when Bernanke was in there, that anytime the stock market was sliding, they would say, looks like it's time for another round of QE. And then all of a sudden the market would rebound, often just on the news that, another round of QE is coming. Okay, so that's partly what Bessent's getting at here. Later, he quotes this other guy, Petro, who says, one famous investor wrote, quote, financial markets have come to expect the Fed to intervene in response to any sharp declines in equity prices. That's the end of that quote. The situation, wrote another commentator, effectively set up a situation of, quote, socialism for investors, capitalism for everyone else. Okay, and so this is part of the post-mortem on the housing bubble and financial crisis, is that, because again, part of the story there is, what the heck? Like, these ratings agencies were wrong. They were taking these mortgage-backed securities and CDOs and whatever, giving them AAA ratings in some cases when the things should not have been AAA. But still, all those big funds that bought into them, why weren't they, why didn't they do their due diligence? How come they didn't have their quants analyzing this stuff and so on? And part of it is the things were so complicated, they just didn't understand. And I'm like, I was actually calling people afterward that I knew personally, just kind of off the record. Like, I just want to know what happened. I'm not here to blame interventionism or blame cap. I just want to know, like, in your words, what the heck just happened? How did you guys get stuck holding this stuff? Like, that's not good for you, right? It's not in your interest to make bad investments. How did this happen? What happened to your, risk controls and things like that? And so one thing was, a guy told me, we didn't know. It was like there were these physics PhDs down the hall that would analyze this stuff and come back and tell us, this is what we think the riskiness of these mortgage-backed securities with little pieces of thousands of different mortgages all thrown into this thing. And we got this tranche here and blah, 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 right? It's hard to analyze that, to know. You can analyze what you think the home price market in Phoenix is going to do, but that's not the same thing as saying, we got this third riskiest tranche in this pool of securities that's drawn from all over the country and mortgages, So anyway, that was one part of it. But another one is, I've seen elsewhere that some people were thinking, if they were sitting there doing their assessments, and someone said, well, this could happen and this could happen. And what if this happens? And we don't want to be caught. And at some point, you're kind of like, well, look, if you're going to be, just so you're not losing the train of thought, I'm talking about like as of 2005 and 2006, is some of these institutions were just piling up on this stuff, that the returns in the short term were great, but people were getting a little nervous about this housing market seems pretty frothy. And what happens if things turn around? And so apparently, at least in some of those decision-making boardrooms or whatever, people did say, Well, I mean, if that ever happened, the Fed would come in and rescue us, just like it has shown it has done since 87. It was kind of like, if the way you're painting a scenario that's scary, saying our firm should not buy more of these types of complicated derivatives, is that you're assuming there's this systemic problem and the whole system's going to come down, then we don't really need to worry about that. We can go ahead and ride it on the way up, because if everybody's going to get crushed, surely the Fed would come in and save everybody. They wouldn't let that happen. That was the idea. Okay, but notice, if lots of firms are thinking that, then that's partly to explain why did they all head towards the cliff? Like, why didn't they realize in their own self-interest to pull back? Is because they thought, well, come on, we can't all go over the cliff. The Fed's not going to let every household investment bank go down. Okay. And then along those lines, Bessent says, the subsequent asset bubble stemming from the Fed's easy money policies in the early 2000s contributed to the buildup of risk in the financial system that ultimately led to the 2008 financial crisis, right? So again, dovetailing exactly with what I've been saying here. I've linked to it a lot before. I'll plug it again. My book, Understanding Money Mechanics, I'll link to it here. It's a free PDF. You don't have to go buy it. But at least one of the chapters in there, I go and empirically lay out the case that the Fed contributed greatly to the housing bubble in the United States, in case you want to see me show. Besides me just saying it in words and appealing to you, if generally you don't like government and central bank intervention, I can show you with charts and stuff that the timeline fits in terms of when the Fed was pushing down interest rates up. That's when mortgage rates go down too, which makes sense. That's when you see home price appreciation accelerate. Then the Fed turns around, starts raising interest rates up. And that's when the housing bubble peaks and starts coming down and right. So, okay, here's a good one. Bessent later goes on to say, the Fed's erroneous models of the economy also relied on a fundamentally false and self-reinforcing assumption, that inflation is primarily determined by inflation expectations, which are in turn influenced by the Fed's own communication and credibility. In other words, the Fed believed that simply signaling its commitment to low inflation would be enough to maintain price stability. Okay, so again, that might sound like he's attacking a strawman, but he's not. That was a big part of what the Bernanke Fed was doing. Is look at Ben Bernanke is a college professor, and he was relying there on academic research to this effect that you would get more bang for the buck, no pun intended, with monetary policy, meaning you could achieve a certain level of real GDP growth with lower consumer price inflation if everybody understands what's coming, right? So if the Fed, it's not enough just to say, what's the Fed in practice going to do at this meeting and the next meeting and so on up for the next 30 years. But if everybody has a good sense of what policy rule is the Fed using, so based on the information they're going to have at the time when these Fed meetings occur, if we have a better idea of what rule are they going to use to map from what the unemployment and CPI rate and blah, blah, blah are at those future dates to then say, what are we going to do with monetary policy? That you can do models and show if the players in the economy know what rule the Fed is using. And in particular, if the Fed can commit to something ahead of time that might make it more hawkish than it would want to do in the short term, right? Like in other words, at a given meeting, maybe they want to juice the economy because that's going to bring down unemployment, but at the cost of higher inflation in the long run. There's standard modeling results that show if the Fed could just commit to having a more hawkish policy up front that everybody believed, was credible, then the higher unemployment that you get in terms of being staunch and saying, no, we can't let CPI inflation go above this ceiling. We got to stay tight. That the amount of unemployment you suffer from being a tough guy on inflation is lower if everybody knows up front what your rule is going to be and they believe you're going to stick to it. That's the idea. Okay. And so that's the kind of stuff that Bessent is referring to. So they weren't just making it up because it does sound kind of goofy. But on the other hand, Bessent isn't lying when he says a big component of what the Bernanke Fed brought to the table was to tell people, hey, we're going to do a better job of communicating, and through our transparency, that right there is going to bring down inflation. And you got to understand the context here. Alan Greenspan, the prior Fed chair before Bernanke, famously was a sphinx. He would deliberately say stuff at press conferences and whatnot that was completely meaningless. Like he would just talk in big circles. Like it would sound like he was saying real deep stuff But afterwards, like, what the heck did he just say? And later he admitted, like in his memoirs and whatever, that he would do that on purpose. And he thought he was being clever and, oh, I can't tank the market if nobody even knows what I just said. But Bernanke took the opposite approach as this academic college professor guy to say, no, if we just explain clearly to the children what the rule is, well, then probably the behavior will improve. That's the idea. Okay, let me just make two more points here. So one is something in here that I had never heard this before is the Fed has its own police force. And so he says here, the Fed also has its own police force, the Federal Reserve Police. Perhaps unsurprisingly, the Federal Reserve Police has no website and the Fed discloses little information about its operations, though its primary function is focused on securing Fed facilities. Presumably, the Fed downplays its police force because increased public awareness could raise questions about the need for taxpayers to underwrite it, particularly since this force is not appropriated by Congress under the typical process for spending decisions. Okay, so like I said, I have never heard that before, and I've been researching this stuff for a while, so that's kind of funny. It reminds me this anecdote that so it's September of 2008, there's the big financial crisis, they let Lehman go down, the Fed comes in, rescues AIG by injecting $85 billion, and apparently, I think it was in September, it might have been early October, but I think it was September, there's an emergency meeting in Washington, Bernanke's there, the Treasury Secretary, Hank Paulson at the time is there, Goldman Sachs guy, and Barney Frank, who's no slouch, ways and means guy. Like Barney Frank is not afraid to take your money. He'll say it's his. Okay, so he's not afraid to grab billions of dollars and spend them. But apparently at this meeting, he asked Ben Bernanke, you're putting $85 billion into AIG. Where'd you get that money? Like, do you have it? And Bernanke said, Mr. Fred, I don't know if he was in Congress, like, we have $850 billion. Now, what's funny about that is they have 850 quadrillion. Like, it wasn't that, we could only do 8, you know what I mean? Like, he said we have 850 billion, like, to impress him, but really he could have said any number. The point was, no. The way the Fed works, certainly since 1971, is if they want to buy assets or make a loan, they just do it electronically and just mark up their assets and liabilities accordingly. They don't have to take the money from somewhere. Whereas apparently Barney Frank was still thinking, like, yeah, here we're in DC and we got $1 trillion plus budgets and stuff, but we have to take the money from somewhere or borrow it and get it from people who already have it saved. What do you mean So anyway, I just thought that was funny just to kind of show that even somebody as savvy and politically astute and whatever, and nobody's sucker as Barney Frank, had no clue about the power of modern central banks. And so here that's why this amused me that apparently the Fed also has its own police force. Okay, so let me just wrap up. You might say, so what's the conclusion? And there it's a little bit flat. He's basically just calling for, he has some specific recommendations about oversight from certain entities, but I can read you the last two. At the heart of the Fed's independence lies its credibility and political legitimacy. Both of these tenets have been jeopardized by the Fed's decision to expand its role beyond its traditional mandate and engage in what amounts to a gain-of-function monetary policy. These actions have eroded the institution's insulation from political pressure, risking its ability to function as an independent entity. Okay, so I want to stress, that is the specific argument he was making, buttressing it with all kinds of empirical evidence and going off on tangents and things. But he was saying, once the Fed enlarged its mission, is now dabbling in all these things. We can do mortgage-backed securities and we can do this and we can do that. That now a bunch of people are going to lobby the Fed and say, well, geez, if you rescued the housing market, or more specifically, the mortgage-backed securities market, right? They didn't go and bail out individual homeowners who were underwater on their mortgages. Well, what about, this sector over here? Can you come in and buoy that, that up? So, whereas if the Fed had just been old school when 2008 hit and just said, no, we can't buy mortgage-backed securities. What are you talking about? We're not allowed to do that. Then that would have closed the door to that. Right? So that's part of his argument there. Okay. Looking ahead, it's essential the Fed commit to scaling back its distortionary impact on markets. At a minimum, this likely includes the Fed only using and then halting unconventional policies like QE in true emergencies and then coordination with the rest of government. It also likely requires an honest, independent, and nonpartisan review of the entire institution of all its activities, including monetary policy, regulatory policy, communications, staffing, and research. We now face not only short and medium-term economic challenges, but also the potentially dire long-term consequences of a central bank that has placed its own independence in jeopardy. To safeguard its future and the stability of the U.S. economy, the Fed must reestablish its credibility is an independent institution focused solely on its statutory mandate of maximum employment, stable prices, and moderate long-term interest rates. Dun, dun, dun. Okay, so that's how he concludes. So you can see there, he's not even against QE. He's just saying only when there's an emergency, and then you got to stop once the crisis is spent, right? So that's what I meant. This is actually not that radical of an essay. He's not doing anything nearly as radical as me saying, let's get rid of the Fed. But that's where he's coming from. But the calls for more oversight and then an audit and that kind of thing, if you're cynical, you can look at that and say, oh, see, so here, yes, he used a bunch of academic research, made a bunch of perfectly legitimate points about how the Fed's been out of control, but ultimately it's coming down to, and that's why we're going to rein you in under the Trump administration. Okay, so that's kind of coming full circle here. Okay, well, I hope you learned some stuff and that helped you folks as you navigate the financial sector. Of course, I will watch this with great interest. As I say, recording this right now, the current news is a court said that Trump is not allowed to remove Lisa Cook from the Board of Governors before the next Fed meeting. And so we'll just watch that situation and see how that goes. Thanks for your attention, everybody. See you next time.